All right, today we are diving deep into the stock works. And wow, did it have a day. It saw a massive surge that pretty much came out of nowhere. So our job is to get under the hood, look at the data, and figure out what is really going on here. Let's get into it.
I mean, just look at that number for a second. Over 35% in a single trading day. Moves like this, they grab headlines, they get everyone talking, and for a very good reason. This is the kind of jump that can make people a lot of money, or it could be a massive warning sign.
So that brings us to the big question for this whole explainer. Are we looking at a rocket ship on the launch pad, ready for a sustainable blast-off to new highs? Or is this whole thing just a fragile house of cards built on hype and about to come tumbling down? We're going to follow the data and see where it leads.
Okay, let's start with the good stuff. Let's build the case for the bulls. What evidence do we have that this is a genuine, powerful move? Because at first glance, the technicals are painting a really compelling picture.
So, to understand the bull case, we first need to talk about a key indicator called the ADX. The easiest way to think about it is like a speedometer for the stock's trend. It doesn't care if the trend is up or down, it just tells you how powerful it is. A high number means there's some serious muscle behind the move.
Now check this out. This slide shows an incredible imbalance. The ADX for Works is over 53, which in technical terms is considered very strong. But here's the wild part. Look at the buyers versus the sellers. The buying pressure is clocking in at 61, while the selling pressure is, well, it's barely even there, at less than 6. It's a complete landslide.
And it's not just one indicator saying this. The Arun oscillator is literally maxed out at 100, which is basically screaming strong trend. The overall technical score is almost 80 out of 100. And even the risk-to-reward ratio is looking good, suggesting that, based on this momentum, the potential gains are outweighing the potential losses.
And to top it all off, you've got all the short-term moving averages stacked up neatly right below the current price. Why does that matter? Well, traders see these levels as a kind of floor, like a safety net. It shows that this recent momentum has been steady and it's building a foundation of support. So far, the bull case looks pretty rock solid.
And you knew there was a but coming, right? This is where the plot thickens. For every strong bullish signal we just looked at, there's a sneaky, contradictory piece of data hiding in the background. So let's look at the red flags, because this is where things start to get a little weird.
I mean, the price chart is just screaming upwards. You can't ignore a 35% gain. It looks like an absolute stampede of buyers pushing this thing to the moon.
But here is the twist. The volume, the actual number of shares being bought and sold, isn't really backing up this big move. And in the market, when price and volume start telling you two different stories, you have to pay very close attention.
And here's the problem in a nutshell. We have two key indicators that are supposed to track money flow, and they are pointing in completely opposite directions. The on-balance volume is positive, which is good, but the Chaikin oscillator is negative, suggesting that even though the price popped, the big money might actually be selling into the rally. That's a classic divergence and a major red flag.
This brings us to another really important concept, being overbought. Think of it like a sprinter who just ran a 100-meter dash in world record time. They're winded, they're exhausted, they can't just immediately do it again. Well, a stock can get exhausted in the exact same way after a huge run-up.
And the dashboard for WORX right now is flashing some serious warning lights. The CCI is at an absolutely insane 446. The money flow index is nearly 99 out of 100. And the Stochk RSI is completely maxed out at 100. All of these are essentially shouting that the stock has run too far, too fast, and is now dangerously overextended.
And as if that wasn't enough, there's a statistical model called linear regression. It tries to calculate a fair value based on recent prices. And right now, it's actually predicting a price that is below where the stock is currently trading. It's just another piece of the puzzle that doesn't quite fit with this massive price surge.
So what we have here is a classic showdown. We have incredibly strong momentum pushing one way, and we have serious signs of exhaustion and weakness pushing the other. So what happens when an unstoppable force meets an immovable object? Let's break down the three most likely scenarios from here. Okay, scenario number 1, the bullish breakout. The momentum is just so powerful that it plows right through all these warning signs and pushes towards the next major resistance level around 58 cents. Scenario number 2, the bearish reversal.
That volume problem we saw turns out to be a trap, and the price comes falling back down towards support near 26 cents. And then there's a third way. It just goes sideways for a while, consolidating as the bulls and bears fight for control.
So which path is it going to take? Well, the key is to watch these levels. You want to look at 46 cents as the ceiling. If it breaks above that, the bulls might still be in charge. But if the price falls below the floor at 33 cents, that could be the first big sign that the bears are taking over.
So, after looking at all this conflicting data, what's the final verdict? Well, it really all boils down to a situation of extremely high risk and potentially high reward. It's a true trader's dilemma.
And here you have it, the entire puzzle on one side. On one side, you've got plenty of reasons for optimism, an extremely strong trend, powerful momentum, and what looks like a favorable risk-reward setup. But on the other side, you have every reason to be cautious. That big volume divergence, a whole host of overbought signals, and just a ton of volatility.
And really, this quote from the source analysis just says it all perfectly. You've got undeniable strength on the surface, but there are also significant, undeniable risks lurking right underneath.
Ultimately, what this really shows us is that a single, big number, even a 35% gain, never tells the whole story. The data is pulling in two totally different directions. And that leaves us with the final question, right? When you're faced with such a clear contradiction between powerful momentum and underlying health, how do you decide which signal to trust?